Alright, what's happening people? Welcome back to the channel. So today I've got a special video for you. We're going to go through the low ADR and the high ADR inside of trading. So last week we took 3 trades and all 3 trades were profitable from trading the low ADR. I'm going to show you exactly how to do it, break it down step by step in short form content so you guys can take it away with you, apply it in real time and make profit just like I did and like all my team did this week. Let's get straight into this. So the high ADR or the low ADR inside of trading is one of the most important things that you can use in your arsenal as a trader. So what high ADR essentially means is that an average stock will move, an average stock share, whatever you're trading, crypto, will move a specific amount of points or pips in a single session. So we know there's a range the price likes to go through. So it's either going to go up or it's going to go down. If it comes down and hits the low ADR, then we understand that we can take a long and start trailing towards the high ADR because there's liquidity points stuck inside of those zones. The reason price has shot down is to acquire liquidity and also trap traders into the short. So when it hits its low average daily range, typically, more often than not, price will not continue lower. It's only going to come back into the zone. It's going to start trailing back upwards to go and take out the people that are induced into the shorts and take their stops out. So what do we want to be doing? We want to be trading with the market maker and taking price higher. And vice versa for high ADR. If price shoots up to the high ADR, we know that we need to be trailing back down to the low ADR. So if it's at high ADR, you aren't going to take a long from that position. You're only going to be looking at taking shorts because price will typically not move past that point. So it's a really good advantage to have on your charts, guys. So this is for anybody that's new to the channel. This is exactly what we do. So any single trade that you'll ever see me take are inside of one of these 3 macros. So we have the first AM macro that runs from 9:45 to 10:15. The second is 10:45 to 11:15. And the PM session is from 1:45 to 2:15. Okay, so why are the macro times important? So significant news events will happen prior to these macro sessions. So at the 9:30, you have the New York futures market open. It's a major event. All the traders are at the desk. And we want to be taking advantage of that. When they've picked a direction, we want to be going the opposite direction. So that's why the macro time is at 9:45. So we get a 15-minute window where prices are going to make the manipulation. And then we're going to wait for the distribution. That's exactly what we're doing, guys. And the same for the second AM macro. The reason the second AM macro is important is because during the first hour of the New York trading, there's going to be a trap formed. So if you miss the trade during the first AM macro, you'll get an opportunity to catch a trap during this second AM macro, which basically means if prices run in a certain direction and you've missed a trade, you'll have an opportunity to trade the opposite direction during the 10:45 to 11:15. And the PM session, of course, this is the lunch hour. So the lunch happens obviously between 12 and 1 o'clock. So then we have 45 minutes to wait for the stop hunt, and then we're going to catch the trade going the opposite direction. It's very simple, guys. There's no need to overcomplicate it. That's why I keep these slides very brief and not too much information in your face. If you want to read about it a little bit more, I've just written this little paragraph that you guys can read if you want to take it even one step further. But essentially, I keep these slides so simple for you guys because trading really is simple. There's a lot of people online overcomplicating it and making it sound a lot more difficult than it is. It's very simple, guys. You're looking for one setup at one time frame and you stick to it and you just do it every single day. You never change your strategy. What's the point? You've got something that works at 70% win rate. Why are you going to change it? Just let it run its course over time. You know, this is an investment. You're investing in making more money with the small amount that you have by using leverage inside of the markets. So over time, you're going to make more money. You just have to stick to your rules and never divert from the plan. It's the most important thing I can tell you guys. Welcome back to the channel, guys. So today we're just going to go straight into the charts and we're just going to do some live trade back testing and breakdowns of the trade that we took during the week inside of the group, because there's been one consistent thing about all of the trades that we took this week. They've approached the low ADR. So it's only right that I make a video explaining how you guys can trade this on your own, so you won't need me by your side, so you can take this away with you and do it yourself and apply it in real time. Okay guys, so the first thing we're going to do is we're just going to look at this date. So you can see this is Tuesday, the 25th of February 2025. So we can see here it's the low ADR, because this won't show up on my actual charts when we do the back testing, but it's just proof that we are at the low ADR. So I'm going to show you how to apply this and put this onto your charts and take advantage of this system. Okay guys, so this is the first example we're going to go through. This was on Tuesday, the 25th of February. So as you can see, what's price been doing since the 9:30 open? Price has been consistently dropping and it's hit the low ADR. So the low ADR is the average daily range. So from the daily open, this is how many points Nasdaq will move on average per day. So we know the price isn't likely to come down from here. So anybody taking shorts inside of this area, which you can see has happened, which is present with the red vector candles. So the shorts have been induced, and now it's time to come back up and fill in some of the imbalances. That was the idea that we had. So you can see here, we're at the low ADR. And then we're going to put in our fair value gap. So our fair value gap rests right inside of this zone right here. And what do we have inside of this zone that you guys need to be paying attention to? Green vector candle. So we have a green vector candle inside of that zone. So green vector candles means that a big player in the game, institution, bank, market makers, whatever you want to call it, they're inside of the market. So they've sent price down all morning, and we're getting a green vector candle, the first one we've seen this whole move down. So we know a big player's just bought in right here. And a big player doesn't buy in to lose cash. They're buying in to make money. So we need to be getting in on this move. So let's move on a little bit. And there we go. Right into our session that we like to trade. 10:45. Same story as normal, guys. 25 stops. Same story as normal. 25 points as the stop. And then target, whatever, these highs. And then very simple. So on this trade, we secured 69. I think we scored 69.5. Let me get that up right now. So here we go, guys. You can see long NQ at 1546, which is this candle right here. That's where we got in. And you can see we stopped out at 48 points. So we managed to secure, I think it was the imbalance of this candle. So it's actually 52 points. But there you go. So that's 52 points in the bag just from trading the low ADR. It's so important that you have this on your charts, guys, because this will give you an indication if you want to be taking shorts or longs. Let's get into the next trade. All right, guys, so let's get into the first trade of the week. This is on the Monday. So as you can see, where do we have it? We have February 24th, and we took the long at 1608, and that's 1608, which is right here in this imbalance of the fair value gap. This is all in UK time, but if you translate it, it will be exactly the same. So let's get a replay on here, and we'll be able to see exactly where the low ADR is. And when you look at that, low ADR, low average daily range in sight. So what do we have? Same thing. Green vector candle pushing price higher. What have we had? Consistent red candles dropping the whole time. So we know market makers sending price down to only get a return on his investment at a later price. So let's move forward. Okay, so you can see price is now displaced above the last swing high, which rests at this point right here. So you know the market structure shift has happened because we've got a downtrend and we've changed the trend. The trend is now upwards. We're getting pink and violet vector candles at the lows, so it's induced the shorts. People are taking shorts from this point. Market maker has to go long to involve the business model. The business model is, if market makers go in short, he has to open an opposite contract against you to go long. So what does he want to do? He wants to induce you into the shorts. It's the trap. You guys need to be fully aware of this. This is the business model. All of this is irrelevant unless you understand the business model. So what do we have in here? Fair value gap. And what's the time? It's inside the macro session. Guys, this is so simple. Like, it really is easy if you just apply yourself. So there we go. So let's take this trade. $25 points as usual. And then we targeted the daily open. Okay, and there's one key thing that you guys need to remember. You always put your stop 2 swing lows below current price. So our stop would have been here at one point, and then we would have moved it to here because we've got this swing low right there. So our stop would have been right here at 21,598. And eventually we were stopped out, but we were already out of the trade by 80%. As you can see, if you come into here, first TP smash, so we put in all the TPs and second TPs. 570. Come all the way down here, 570. Long gone. We've already secured second TP. And all we do is we leave one running contract to target the highs, daily opens, New York opens, data highs, data lows, you name it, we'll work it out in the session. Okay guys, so on to the final trade that we took this week. Look, if you haven't seen a pattern over the last 3 trades we just showed, or the last 2 trades, sorry, that we've just shown you, can you not see the exact same thing is happening? Price will come down, hit the low ADR, and then move away. So, once again, let's have a look. So February 27, long NQ at 1512. So where's 1512? Right there. So what do we have here? The exact same story, guys. Market structure shift, fair value gap inside of the zone, green bet to candle present, take the trade. It's as simple as that. 25 stop right there, and then you target daily open. And then you go, we've stopped out of this one and secured. How many points do we secure on this one? 101 points. 101 points right there. So that would be the imbalance of the red vector candle to the left. So it's really that simple, guys. This is all the trades that we took this week. So if you guys are interested in learning how to trade like this in live streams, because I take every single trade we take live. So if you want to go watch on my YouTube channel, it's there. It's an open ledger. You can go and watch whatever video you want. Of all the trades that we take during the live sessions, if we take a trade, it'll go on YouTube.